This is the Cryptonomics Podcast, telling you why cryptocurrencies are the kryptonite to the traditional banking and credit systems. Learn how to store, manage, and spend your wealth in the cryptoverse. Listen about Bitcoin, Ethereum, and decentralized finance, and hear from our successful crypto investors and miners about their strategies. Whatever you're interested in learning about, Cryptonomics is your one-stop shop to everything crypto. Now, here is your host, Ty.
Hey everybody, welcome back to episode 5 of Cryptonomics. As always, you have me, your host, Ty, and we got CJ on the line again. We got an exciting episode in store. There's a lot going on right now. We got the stock market crashing. We got price corrections everywhere, and we'll get right into that. But the first question I have for you today, CJ, is a futuristic question. You hear a bunch of crypto analysts, crypto experts always going into their price predictions for Bitcoin. You know, I've heard 100K, I've heard 500K, I've heard a million. I guess the most average answer you hear is, if it takes over gold's market cap and hits that $10 trillion market cap, it can see a 500K Bitcoin price. My question for you, CJ, is if Bitcoin were to start eating into the bond market cap and start being looked at as more like a bond type of investment, what would that look like for Bitcoin and crypto in general? And, what would that do to the price and overall sentiment of crypto, in your opinion?
Yeah, well, that's a great question, and it's an astute question because that's the path that we're on right now. And, the mainstream narrative is that, Bitcoin is digital gold, it's better than gold. And people are latching onto that idea. And that idea is true. But the mainstream narrative is like 2 and 3 steps behind the actual development of the technology and the ecosystem. So, institutions are buying right now with the idea that Bitcoin is a store of value and an inflation hedge like gold is. And they're right, it absolutely is. In fact, it's actually an even better hedge because it has a lower inflation rate, meaning that we know that there's a finite supply and we know at what rate that supply is being pushed into the market. Whereas with gold, we don't really know what that supply is, and we know it's being pushed into the market, pulled out of the ground at a faster rate than Bitcoin is. So Bitcoin is a harder asset and therefore a better store of value and inflation hedge against the dilution of the dollar. But that's not where it stops. Well, it is where it stops for gold, but not for Bitcoin, because with the advent of decentralized finance through blockchains like Ethereum, what we're seeing is the added characteristic of yield generation. Now, generating yield is something that we see in the bond market, like you mentioned. And the bond market is a $100 trillion plus market. It's not like gold at a $10 trillion market where Bitcoin would have to get to 500,000. It's a $100 trillion market where Bitcoin would have to get to $5 million plus per Bitcoin in order to start to interact with the bond market. And I think eventually we do see that. But for those of you who have been listening to us, you know that the cryptonomics cycle is how we look at the market. And that cycle is based on the halving, with the halving being a catalyst to a new price discovery cycle. So although I do think those prices are attainable in the future, they're not going to happen until another, the halving in 2024, stock to flow goes to 1 million. And then there's going to be a halving in 2028 and stock to flow increases again. So I do think we see those prices, but probably not on the timeline that a lot of retail investors want to see those prices. I think this cycle we can get up to 90 to 140,000. Perhaps if we see hyper Bitcoinization, like we talked about in our previous episodes, and all companies start to add it to or at least 50% of the companies start to add it as a treasury reserve asset, that is the kind of fundamental momentum that I think could push us to the 500,000 range this cycle, but we haven't seen that yet. So I'm still of the thought that we are still going to see another bear cycle, another accumulation phase, another expansion phase, and reaccumulation phase, the typical market making process as Bitcoin becomes more mature and the network gets built out, but not only the network, what it's attached to. So that's what we're excited about, especially me, about the future of Bitcoin and decentralized finance, because that added characteristic of yield generation is pretty rare. It's hard to find that. Correct me if I'm wrong, but if you have rental property, and I know you're involved with that, you get to generate income from your property. Is that right?
Yeah, I mean, ideally, whenever there's government restrictions where no one can travel from state to state, it makes it kind of hard. But yeah, I mean, that's the goal.
Yeah. So the whole point is that you are taking in a sum, you're taking capital and you're investing it, and it's producing a yield, and that's based on your rentals. So that's real estate has become such a good investment and a strong foundational investment, because not only does real estate guard against inflationary pressures as it gains value cyclically over time, but it can also generate income for you. So this concept of generating income, maybe even passive income, is where yield comes into the picture. And with bonds, because the dollar is continuously diluted, bonds have to generate a yield, because if they didn't, then you'd be losing money year over year. So the idea of the yield is you're going to put a capital sum in, and each year you're going to be paid that percentage. So for like a 10-year note right now, it's like 1.6%. So you get 1.6% per year for 10 years. At the end of the 10 years, your bond matures and you get paid your principal plus your interest. And the interest earned is your yield. Well, Bitcoin, unlike gold, can generate a yield for you. And that's because of decentralized finance. So you wrap your Bitcoin, move that value from the Bitcoin blockchain into the Ethereum blockchain. Once it's in the Ethereum blockchain, it can now interact with these decentralized finance protocols, automated market makers, oracles, decentralized exchanges, all provide different opportunities for you to generate yield with your stored value. And right now, even if you didn't be your own bank and be your own broker, and you went to a platform, say like Nexo, you can earn up to 6% on your Bitcoin, and you can earn up to 10% on dollars. So, 6 to 10% is way better than any bank currently offers. And it's all happening because of the value that Bitcoin is delivering as a reserve asset to the digital economy. So just like our original economy was built out on gold and the dollar was representative of gold, now Bitcoin is representative of that stored value in the digital economy. And there's a sub economy, a credit economy being built around that value. And because that credit economy is free market, and like we talked about before, it's based on being over collateralized and under leveraged, whereas the traditional system is opposite. The traditional system is very risky, and the crypto credit system is not. So those healthy rates are attracting large sums of money, because smart money chases yield. Smart money doesn't want to take risk. It wants low risk with medium reward. And that's what you get in crypto credit markets, because you can facilitate those credit markets with the stored value of your Bitcoin holdings. That will allow Bitcoin to go after the bond markets, because that allows Bitcoin to not only be the store of value and inflation hedge, but also a yield generating asset.
Gotcha. So right now, you have to wrap your Bitcoin for it to be in the Ethereum blockchain, so you can, generate yield through decentralized finance. Do you see a day where eventually you won't have to wrap your Bitcoin and there'll be like a decentralized finance ecosystem built on the Bitcoin blockchain? What will that look like, do you think?
Yeah, I think, that's being built right now. But I still think there's always going to be reason to wrap your Bitcoin. And this comes down to having a fundamental understanding of making markets. You know, there's a reason there's not one bank in the entire world. That's just because there's too much liquidity. There's too much. You've heard it in politics said like this: local problems require local solutions, right? You don't want to bring in the Fed to solve a local problem. You want to use the local sheriffs and the local officers to solve that problem because they know that area best and they know how best to serve. So it's the same thing with markets. Bitcoin is a big settlement network. It's not going to make sense in the future for somebody that is a small player to be paying large fees to settle small DeFi profits on the Bitcoin blockchain. It will make sense for multi-billion-dollar institutions to do that. So each blockchain and each ecosystem is going to have a different type of demand on it. The demographics of each blockchain are different. One is meant to serve institutional settlement. One is meant to serve a high class of traders and market makers. One is meant to serve retailers. One is meant to serve the unbanked. There's multiple markets all over that all need to be served, and they can't all be served with the same solution. There is no universal solution to some of these local problems. We need local solutions to local problems, which then are networked together through protocols like DOT and Orion and other people who are working on bridging these different blockchains together with wrapping protocols like REN protocol for your Bitcoin. That is what's going to facilitate a bigger, stronger, healthier crypto credit market versus a one blockchain serves all type solution.
So when you wrap a Bitcoin, you're taking it off the Bitcoin blockchain, correct?
No, you can never take a coin off the chain. But what you're doing is you're giving that coin over into somebody else's custody so that they can maintain that coin is being locked, right? So you'll say, you know what? I want to wrap my Bitcoin. And they're going to say, okay, please send one Bitcoin to this address. And whatever wrapping protocol you're going to use is going to be the custodian of that Bitcoin. So you'll send your Bitcoin from your address to the address that they tell you to send it to. Then once they receive your Bitcoin, they'll issue or mint a wrapped Bitcoin on the Ethereum blockchain that is representative of the Bitcoin that they maintain custody of on the Bitcoin blockchain. And then when you want to come back, same thing. You send your wrapped Bitcoin to a specific address. Once it sees it in there, then it'll burn that wrapped Bitcoin and send this Bitcoin back to the address that you sent it from so that you're back over here.
So you can get the actual Bitcoin back. Like once it's wrapped, it's not like 100% always on Ethereum. Like you can get it back on the Bitcoin blockchain.
Yeah. So think of it as like a bridge. And every time you cross the bridge, you have to pay a fee. And that's all it is. You're bridging from Bitcoin to Ethereum. And it costs a little bit to facilitate that bridge, to cross that bridge. And then you can earn value over here. And you can even bring back more than that one Bitcoin, right? Because it's assets and liabilities. So let's say you take your one Bitcoin and you earn 3. So you can actually come back and take 4 out. Because those wrapped Bitcoins that you come back with, they were created by other Bitcoins being locked over on the other blockchain. So see, wealth transfers. It's not created or destroyed. It's transferred. It's bridged.
So what's the risk of doing that?
Well, the risk is if you don't know what you're doing, you can mess it up and you can lose your coin forever. Or if you do it correctly and you bridge your Bitcoin over to Ethereum and then you don't know what you're doing in Ethereum and you go to a bad protocol or a protocol gets hacked or something like that, you can lose your Bitcoin. So there's risk to it, absolutely. And I think that's why right now the institutions, one of the biggest problems institutions had getting into the Bitcoin market was custody. There were no good custody solutions back in 2017. In other words, if institutions bought Bitcoin, they don't want to hold them in their ledger, in their drawers, right? They don't want to have to like hire a security team. There needs to be insured
ledgers.
yeah, there needs to be insured, qualified custodians in order for institutions to put in institutional level capital. And that's what we've built since 2017. And now you see those institutional level custodians like BitGo and others who are even working with bigger companies to help custody that crypto so that institutions don't have to worry about that responsibility. And that's why DeFi is such a big opportunity right now. Just like they couldn't get into Bitcoin because the proper fiduciary guidelines were not set, they cannot get into DeFi right now because the proper fiduciary guidelines are not set. So the opportunity that we're seeing in DeFi right now is very much like early on in Bitcoin, where we know it's going to be big, we know it's powerful, we know it's important, but the big boys can't even get in yet because to move those big amount of money, the proper solutions aren't there. And the same thing happens in DeFi. People, I think there's 26 billion worth of value locked in DeFi right now, which is only about couple percentage points of the overall Bitcoin market capitalization. So, very few people are using these tools right now. And that's because they're being developed and they're being built right now. And again, that's what makes it such a big opportunity. It's being built right now, just like Bitcoin was being built back then.
So which solutions are being built right now that are going to help bridge that gap for institutions to be able to participate in DeFi with less risk involved?
Right. So I don't think any of those solutions are being built right now. We're so early in DeFi. It's year 3. So we're so early in DeFi that, think of Bitcoin year 3. We were still developing value of Bitcoin, right? We were still discovering price mechanisms. We were still discovering how to make markets. We were still discovering not to trust exchanges, centralized exchanges, right? There was a lot we hadn't learned yet. And I think DeFi is in the same position. There's a lot we have not learned yet. And there are some big protocols coming down the line that could flip traditional finance upside down. And I think we're going to see those protocols emerge, especially going into the next halving, the 2024 halving. And then institutions are finally going to understand, oh my gosh, Bitcoin is not just a store of value and inflation hedge. With this digital economy that's been developed, Bitcoin is now a yield generating asset. And that's going to completely change how people value Bitcoin. And the people who understand that now can look at $48,000 Bitcoin and say, wow, let me make a prediction. This is going to be fun to come back and watch this in 2024.
Let's hear it.
I think the bear market in 2023, I think this is going to be your accumulation price. I think in 2024, you'll look back in 2023 and you'll say, oh, I wish I was buying Bitcoin at 48,000. Just like people look back at Bitcoin now and say, oh, on Corona crash, I wish I was buying Bitcoin at 4,800. That same sentiment will be felt from this level out in 2024 after that 2024 halving. So it's just a matter of time. It's just a matter of letting the coded cycle play out and letting Bitcoin be the black hole that it is, not only sucking in value from people who are looking for a store of value and inflation hedge, but also now starting to bring in money from people who understand that Bitcoin is a yield generating asset. And it's right now, like I said, the institutions, they're going to want to get in, but they can't get in right now. You can't be an institution and be part of a protocol that just got hacked for $31 million. And you got to explain that to your stockholders. These protocols need to be way more developed, way more sophisticated. And there are a few out there, like we've talked about before, Aave, that are really leading the pack in that level of sophistication. And those market makers who have that first market mover advantage and who have developed these sophisticated protocols, they have the opportunity to actually become licensed banks. We saw that being brought up from government officials talking about giving these protocols banking licenses. Well, Bitcoin ETFs were the thing of imagination in 2017. And here we are. And now there's already one in Canada. There's multiple companies applying for them in the United States, and people are saying, yeah, it's probably going to get accepted. So it just takes a little bit more time for people to understand what's going on. That mainstream narrative is usually 2-3 years behind where the market is actually being developed and built. And then the understanding itself is even behind the mainstream narrative. So people understanding that Bitcoin is not only a store of value and an inflation hedge like gold, it goes one better, and it's a yield generating asset like a rental property or a bond could be. And now you're talking about $100 trillion plus market, not $10 trillion gold market.
It's always interesting when 10 trillion sounds like not a lot, right?
That's so true.
Yeah.
So true.
That's very interesting. It's a lot to take in. It's just, it blows my mind that, people are still bearish on it with everything that's going on. Like, why do you think some people like Peter Schiff or like just like the 100% against Bitcoiners are so bearish still, even though there's so much proof going on that it's being accepted worldwide?
Right. I think that has a lot to do with price discovery and market psychology. I mean, people really don't understand how much human emotion plays into the price discovery process. Now, somebody like Schiff he's just like, I don't know. He knew about Bitcoin. I think Max Kaiser said he told him about Bitcoin at like $3. So at this point, he's probably just so mad at himself that he hates it. I can't explain his actions, but as far
he's made no money off gold. He's made zero money off gold the last 10 years.
So yeah, I mean, as far as the rest of the market goes, I think like the mainstream sentiment is negative right now because they just don't understand the cycle itself. On average, the bull phase of the cycle, which is started by the halving, right? The halving is the catalyst to the price discovery cycle. That post-halving price discovery cycle on average lasts about 513 days. Well, we just crossed day 300 in this bull cycle. So we are just past halfway through, and we have not seen the rest of this process finish out yet. And people are bearish. And, I actually told a lot of my clients, I know this sounds crazy, but after the halving, before Bitcoin breaks its all-time high, people are going to be bearish. And they said, no, CJ, that's not going to happen. If it's about to break its all-time high, people are going to be excited. People are going to be like, oh my God, I can't believe it. I'm like, no, you're going to think that because you understand it. But these other people are going to be bearish. And what did we see at 20,000? People calling for a double top, the market being bearish, funding rates being negative. And for someone who follows it and understands the cycle, you're like, how are people even in this mindset? But that is how the mainstream hive mind works. It's always opposite of what the right opinion is. And right now we're seeing that too. People are saying, oh, Bitcoin topped out at 58,000. It's done. It's coming back down. The dollar is gaining strength. Bitcoin has no shot. And it's just like, who could, Bitcoin went from 4,000 to 48,000 in less than a year. We're telling you why it did that. We're telling you how to value it. We're telling you what mathematical numbers to plug into the equation to figure it out for yourself. And then you're still in disbelief. It's market psychology. It's why the contrarian investor always outperforms the market.
So earlier you mentioned the Bitcoin ETFs that are set to launch, or I guess one did launch in Canada. What's in a Bitcoin ETF? I mean, if it's a Bitcoin ETF, it has more than just Bitcoin, I'm assuming, right?
Yeah. So I'm so happy you asked this question because I'm pretty passionate about this answer. A Bitcoin ETF is not a claim on a Bitcoin. Okay. If it's not your keys, it's not your coins. These ETFs and like the Grayscale Trust, all these are financial tools that are being used to profit off of people who have their money market funds stuck in the stock market. So let's say that you're somebody, you make $40,000, $50,000 a year. You don't really have that much extra spending money, but you do have a 401k and your company matches you. So you're going to have stocks, you're going to have this, you're going to have that, you're going to have whatever risk adjusted return that you select for them. They'll give you 3 options, the low, the medium, the high, and you pick what you go for. But you don't get a choice of what you individually hold. And then there's people who say, you know what? That's my money. I want to self-direct my 401 or IRA, and I want to say what it's going to go in. And they say, okay, that's fine. You can do that, but you can only pick from this list. And most of that list is the traditional money market funds. But a lot of times you can't get like pink sheets or anything like that, so you have to stick with the main indices. And that's what an ETF is. It would give people who are stuck in that market, it would give them the ability to get exposure to Bitcoin. But again, it's just a piece of paper that says you have a claim to a Bitcoin. That's all it is. It's like the gold and silver derivatives market. It's like a piece of paper that says you have a claim on gold at the market price. It's not an actual piece of gold in your hand, and there's not enough gold in the world to fill all of those claims. So I think ETFs and trust Grayscale Trust is different because for each share, there's a Bitcoin that they hold in the trust to represent that share. Where the ETF, you can see that kind of thing setting up. But again, if it's not your keys, it's not your coin. The best thing to do is, in my opinion, completely self-direct your 401k, start an LLC, become your own custodian, take that 401k and properly position it so that you're not going to be in these 60-40 portfolios that are just underperforming, even compared to just being in a single ETF based on like the NASDAQ or based on the S&P. That outperformed these 60-40 portfolios.
Yeah, no, I totally understand that. Not your keys, not your coins. But I feel like some people aren't too worried about owning their own coins, whether they're right or not. I think they just want exposure, which is why these ETFs and these trusts have been created. But like back to my question, like what is going to be inside this ETF? Is it just going to be exposure to Bitcoin? Is it going to have other exposure to coins? Is it going to have exposure to mining companies? Like
Well, that's a great question, and I think you're going to see different ETFs pop up. You're going to see one that you're going to see funds based on mining. You're going to see funds based on Bitcoin. You're going to see funds based on a basket of the top 10 market cap coins. You're going to see all different types of funds because there's all different types of demand. And ultimately, the funds are created in order to generate revenue from the people who want exposure. So the people who want exposure, whatever they're demanding, there will be a fund created for that. So there are different type of couple products. Like we said, the top 10, just Bitcoin, just Ethereum, Bitcoin and Ethereum, or the mining stocks. So yeah, I'm sure you're going to see all 3 of those once we make that big hurdle and the Bitcoin ETF gets approval in the United States.
That's interesting. It's interesting because I personally think that like a Bitcoin mining ETF would be more attractive than actual Bitcoin ETF because I just rather own my Bitcoin. Does that make sense?
Yeah, I mean, the thing about mining is it only lasts so long.
It's sick,
right? So you have bull phase, bear phase, accumulation phase, re-expansion phase, and then back to bull phase. So for one phase out of all of those, you are very profitable mining Bitcoin. So
gotcha. So right now it's profitable mine Bitcoin, which is why Riot and Mara and all these mining companies are very high valued right now. But what you're saying is, after this bull phase is done in like about 200 days, is I believe is what you were alluding to, that the values of these are going to plummet again because they're not going to be making money.
Absolutely.
So right now you see these mining companies kind of going up with the price of Bitcoin. After bull phase, if the price of Bitcoin keeps rising, will these mining companies' values start going down because they're actually like not making that much money? Or I guess they will be making money because the price keeps going up.
I believe they're going to go down. Everything is cyclical. Even NVIDIA, which a lot of people don't think is too correlated to crypto, and there is very large demand for chips right now that I'm sure they're going to be fine. But I still think they're going to take a hit once the crypto market completes this cycle. And I think we talked about hyper Bitcoinization. That's always a possibility. but we haven't met those requirements yet. So you can't be in that mindset until those requirements have been met. We must be in the cryptonomics cycle mindset, understanding that there will be a price discovery peak. There will be a bear phase. There will be a retrace from the overvalued back down to the fair valued. And there will even be a time where people capitulate. And those are the people that you just talked about. What about the people who don't care about having their keys? What about the people who just want to have a little bit of exposure? Those are the people who are going to get burned. Those are the people who are providing the liquidity for the market makers who are driving the cycle. So it's very, wealth does not just get created out of thin air. It transfers, and it's going to be their money, which is, sorry to say, dumb money, transferring into the hands of market makers and smart money.
Yeah, no, I see what you're saying. So back to hyper Bitcoinization, like what needs to happen for like Bitcoin to just break out of its usual cycle and like just continue its bull run and not go into bear phase? Like what needs to happen for Bitcoin to just skip its bear phase, if it's possible?
Yeah. No, that's exactly how I would say it. And we call that from shifting from the cryptonomic cycle into adoption. Because now you have what's called the adoption cycle, which is the S curve. From the point you shift into that, you go all the way up, and you don't stop going up until the last Bitcoins are mined, all the way out in the year 2140 or so. And then when you finally get up there, you level off. And then the price of Bitcoin will be based more on the demand. But at that point in time, the economy built around it will keep a constant bid under it. So to transition into the adoption phase, I think what we need to see is more than 50% of publicly traded companies have added Bitcoin to their balance sheets as a treasury reserve asset. And I think you're going to start seeing some cities and municipalities start to add it to their balance sheets as well. So I'm looking for 50% of publicly traded companies, and I'm looking for a few cities or municipalities to add it. And you can't have one or the either. It's got to be both. That's what's going to signal adoption. And that's what's going to signal a constant bid under Bitcoin. Kind of like the stock market, the Fed has a constant bid under the stock market. Sure, it goes up and down, but from a macro perspective, there's been a constant bid under the stock market.
No, okay, yeah. So you're saying the trend we've been seeing of like these publicly traded companies buying Bitcoin, putting on their balance sheet, that needs to continue to ramp up. But also like the trend of Miami, for example, putting Bitcoin on its balance sheet and paying its federal employees in Bitcoin. You want to see that happen around the country as well, or even around the world per se.
Absolutely.
So I'm going to make a quick prediction now. And I'm saying the next time earnings seasons comes, you're going to see a lot of these companies releasing statements that they bought Bitcoin right now, but they're not going to tell you until earnings season so they can keep buying it right now.
I think I'm 100% with you. Michael Saylor, he can only say so much. So do you know how he's speaking to us? By sharing what he buys with us. This man is dollar cost averaging at $10, $15 million a pop. He's got over 91,000 Bitcoins. He cannot come out and tell you what to do. But as I usually tell people, don't listen to what people are saying. Watch what they're doing. He is buying, and that's his message to us. He's front running these companies. There were over 7,000 companies. I thought at first it was only 1,200. Then I heard 1,400. He finally came out and said how many companies showed interest in his strategy. Over 7,000 companies showed interest in his strategy. He knows that they are going to implement that strategy, but there needs to be boardroom meetings. There needs to be votes. This stuff takes time. He is front running these people with billions of dollars. And he can't tell us to do the same, but he publicly shares that he buys because he knows smart people don't listen to what they hear because most people are lying. They watch what's being done and they look for results, and he is delivering on those results.
That reminds me of Elon Musk. Everyone was listening to him talk about Doge, and then what does he do? He buys Bitcoin. He never tells anybody he's buying Bitcoin. He's just buying it. But so these 7,000 companies, or probably even more at this point, that showed interest. I feel like these companies aren't going to come out and just tell the public that they're buying it like Michael Saylor does. Michael Saylor realizes that he's the first mover. He's the first person doing it. He's kind of the leader of this corporate revolution. I can see these companies staying, under the table and like not disclosing it as long as possible until until they have the positions that they feel comfortable with, and then announcing it so that the price flies up, because they want to be able to buy it at the level it's at now. They want to be able to buy it at a discount. I mean,
That's
maybe I'm
absolutely
just
right.
thinking completely optimistically and I'm missing something, but
No, you're thinking correctly about it. And people, and it just shows your experience. They would be stupid to come out and promote it. They would be absolutely stupid. Why would they want to pay more for something? They want to pay less. I mean, people don't understand, because a lot of them who are new to Bitcoin are also new to markets. You know why they call it Shark Tank? Kevin O'Leary, Mark Cuban, because these people are sharks. They do not care about you. They do not care about your money. They don't care about your future. They don't care about you. They are sharks. Think about it. They will rip you apart and not even think about it twice. They'll actually enjoy the process. And they already do it to people's 401ks, to their mortgages. Look at all the crises we've had. These are the same people, the same elitist people. They don't care about you. Now all of a sudden they're going to come out and tell you to buy Bitcoin? Not happening.
yeah, especially since there's only a limited supply, like they don't want you to buy it. They want to buy it.
Not happening. And by the way, they're happy that their company has to take boardroom votes and that they have to go through a process, because you think they're going to let their company buy billions of dollars of Bitcoin without padding their own pockets first? All those executives who are voting on that board, some of them might even vote no, because they don't want the company to start buying until it gets over 100K, because they have a dollar cost averaging plan to buy up to 100K. So they're going to vote no until they got their bags.
Yeah, exactly.
Until they're correctly at. That's what's going on right now. All of Wall Street, all of these elites, everybody's saying bond yields are rising because of inflation fears. Well, bond yields don't rise because of inflation fears. That's not how a bond yield is set. That has nothing to do with how bond yields work. Bond yields rise when bonds are being sold off, and bond yields fall when bonds are being bought. Like Bitcoin, bonds don't give two shits about what anything else is doing. That's how yields work on bonds. When they're sold off, yields rise. When they're bought, yields drop. Are they tied to the federal funds rate? Absolutely, they're tied to the federal funds rate. But the Federal Reserve has done nothing but lower interest rates. And the one time they tried to raise interest rates at the end of 2018, the market started tanking. So they immediately started lowering and kept lowering. I don't think they can raise interest rates even if they wanted to, because of all the levels of debt. It would increase defaults to an unsustainable level. So I don't know what the hell people are thinking when they look at that and they say, oh my gosh, I better sell my stocks because bond yields are rising. Well, let me tell you something. You're selling your stocks to the rich people who just sold their bonds, because they know those dollars aren't going to be worth what they're supposed to be worth. So they need to get them into assets. So they're buying your stocks at a discount while you're trading your discounted stocks for an asset that's depreciating. They're sharks. They're playing you. They use the mainstream narrative. They use your misunderstanding to steal your money.
Kind of reminds me of like when you go like lobster diving, how you have to like tease it out and then you capture it. It kind of reminds me of that, like a Tom and Jerry type of shit.
Yeah, it really is that bad. It really is that bad. Everything you don't trust about the government or the system, all of a sudden when it comes to finance, people just come in magical freaking unicorn fairyland. Oh, they're the banks. They got to be fair. They're the banks. They're treating us right. We're not getting screwed over here. You're getting more fucked in the financial system than you are anywhere else.
Yeah. I mean, it's comical to like laugh at when you put it that way, but it's really sad, honestly. Like people, it's like you said, people's 401ks, people's life savings are just getting depleted, and they're reactionary. So, I mean, let's just touch on it now. Like, I guess you kind of explained it, but to a 5-year-old, how would you explain like why the stock market is crashing right now? Is it exactly what you just said?
Yeah, I think that people are emotionally First of all, they do no fundamental analysis and they do no technical analysis. All they do is read a few news stories. And unfortunately, the news is not there to educate you or inform you. The news is there to misinform you. The news is there to drive the stupid money. I don't care what anybody says. Go ask a successful trader. None of them are developing their investment thesis from the news that's being published. Whereas a lot of retail traders will look at a news article like Federal Reserve, Jerome Powell says that inflation could go up. So now all of a sudden they want to sell their stocks for dollars that are going to deflate because there's inflationary pressures. You see what I'm saying? There's mass confusion, there's mass distraction, and it's all about taking your money from you, making sure that you aren't in the proper position. Matter of fact, you're providing the liquidity for the big boys who are positioning themselves in the proper positions. And, you know, people think that the dollar is going to gain strength. Listen, the dollar can temporarily gain strength, but if you look at the trend of the dollar since the year 2001, the dollar is not gaining strength. It's not in a position to gain strength. It's not in a upwards channel. It is not good. And here's why. I can tell you exactly why. Because we pay $3 trillion in taxes, and then we spend $8 trillion on the budget. So every single year, there's $3 to $5 trillion that's being printed, which is diluting the value of our currency. The government overspending is why the currency is being diluted. Now, tack on top of that budget deficit, tack on top of that stimulus and helicopter money and all that, and it just makes it that much worse. So that's what we're seeing, these huge inflationary pressures. And yet the Federal Reserve says inflation is under 2%. But be careful because we might be approaching 2%. Unbelievable. A liar. Inflation was this bad when monetary velocity, please just go on Google and type in M1 velocity, St. Louis Fed, and you will bring up a chart from the St. Louis Federal Reserve, which is an official government research chart that will show you the measurement of monetary velocity. It has gone down, straight down. As much as the M1 money supply has gone up, it has gone straight down. And what that means is there's not a lot of money changing hands before it settles in debt. Pre-coronavirus, $1 might change hands 10, 15, 16 times before it settled in debt. Post-coronavirus, dollars are only changing hands 4 and 5 times before they settle a debt. What does that mean? There's a lot less demand on goods and services. So we've seen these inflationary price results when there's been a lower demand on goods and services. Now that things are opening back up and velocity is going to increase, and now those dollars are going to change hands more times, we're going to see more demand on goods and services, and that's going to cause inflationary price pressures, not only on goods and services, but on hard assets as well, such as real estate and stocks and commodities. Commodities are going to go through the roof, and that's going to cause prices to go up. It's just so clear that things are going to go inflation. So the big boys want you to think, oh, I got to sell off my stocks. I better sell my house because I want to catch the top of the market. I got to do these things, and I got to get those dollars because I want to buy everything at a discount. Meanwhile, what's actually happening is those dollars are becoming worth less and less and less and less and less. And they're trying to get out of the dollar and get your hard assets. And you've just given it to them. Why? Because the news says that inflation is going to happen, and you don't understand what inflation means. You think you're going to need more dollars to pay for things, and you should sell stuff. Actually, it means you should get your savings that's in the dollar and get it out of the bank and put it under your mattress, because it's safer there than it is in the bank. Because if rates go up and keep going up, the bank's not going to have any money to pay you, and then FDIC is going to have to pay you. But then if FDIC has to pay you, they have to pay everybody else. And if they pay you and pay everybody else, how are they going to do that? They're going to print it. And then when they print it, is it going to be as worth as much? Is it going to have as much purchasing power as it had before they printed it? Hell no, it's not. And you're going to lose a lot of your purchasing power. That wealth is going to be transferred into the hard assets and into the hardest asset and economy in the world, which is the digital economy.
Well, I think that's a pretty powerful point for us to end on. I think that is a perfect synopsis of kind of, what the market is trying to manipulate everything into, or not the market, the Fed, and the government. But, before we leave, I wanted to say thank you so much to all of our listeners and our supporters. We did break 500 total listens in 4 episodes, exceeded all of our expectations. We didn't even think anybody potentially would want to listen to us, let alone, continue listening to us. We just wanted to kind of, spread knowledge to the world, even if it was just for a couple people. Thank you for everyone who reaches out and tells us how much they enjoy listening to us and how much they're learning. We're going to keep doing this as long as possible, so we can help people like you guys, preserve your wealth, preserve your purchasing power, and, build your futures, so you can be more successful and not fall into the same, trap that a lot of people do because they listen to the media. So thank you to all of you guys for supporting us, and stay tuned for a new episode coming next week. And again, as always, if you have any questions, feel free to reach out to us on any socials, and we'll do our best to answer the questions on the podcast. And CJ, thank you so much for coming on again today, and spreading the wealth, spreading your knowledge. Like, you're so knowledgeable and experienced. So thank you so much, and we look forward to next week.
Thank you, and thank everybody. I'll see you next time.
Cheers.